Right, well, welcome to Expat Network's latest webinar in our Finance for Expats series. Today we'll be covering retiring to Europe with our guest speaker, Justin Porter, from Business Development Director of Blevins. Before we get started, it was just worth mentioning about questions. If you have any questions, please use the facility you'll see on your screen to pose any questions. We'll aim to answer those during the course of the session. But if we're unable to answer anything, then we'll follow those up by email after the event. So thanks for joining us today, Jason. Perhaps you could start by telling us a little bit about yourself and Blevins Franks.
Okay. Jason Porter, I am the Business Development Director with Blevins Franks. I've been with the firm probably 8 years now. We are a financial services company that majors in effectively tax advice at the outset, from which everything else spreads out: the financial advice, the financial planning, wealth planning, pension planning, etc. All comes from the position of what is your tax position, so that we can provide the advice from there. We're a company based across 5 or 6 jurisdictions. We have an office in Pall Mall in the UK, quite a sizable office there. We're based in France, Spain, Portugal, Malta and Cyprus. We have offices in the Balearics, and also across Tenerife as well. And we also have an office in Monaco. France has probably 8 to 10 offices, similar in Spain. In Portugal, we have a couple, and single offices in Malta and Cyprus. So that's where we provide advice, the kind of places that UK nationals like to move to or retire to. And we're giving kind of linked up advice, connecting the UK side with the side of the country that people have moved to. So a cross-border international aspect of the advice as well. And we're really helping UK nationals structure their finances so that they're as tax efficient as possible. So structured right for the new country that they're living in, but factoring in anything that they may have retained from the UK, be it property, investments. But obviously, there's always the position that from an estate tax and inheritance tax perspective, people are generally going to remain UK domiciled, which retains a UK inheritance tax exposure as well. So it's factoring that into the planning going forwards. And obviously, as people get older and older, that advice becomes more important.
Yeah. Okay. Well, thanks. So we're getting a little sort of sound coming in and out again from you, Jason, but hopefully that will improve as we go forward.
Okay.
So in terms of retiring to Europe, obviously a lot of our audience and the registration data we have are Brits who are moving to Europe. So there are a number of other nationalities as well, but I suppose the first big question is, has Brexit fundamentally changed things for people retiring to Europe?
In general, no, it's not had a huge effect, but the main area where it is having an effect is the area of immigration. So that's really how long you are able to spend in Europe. With the UK leaving the EU, freedom of movement, the ability to move in and out of the EU for as long or short as you wish, for as many times as you wish, has fallen away. So we now have a situation where UK nationals can only visit the Schengen area, so that's 27 member states, can only visit the Schengen area for 90 days in any 180-day rolling period. So any longer than that, then effectively you need to apply for a visa if you want to go for longer than that, and you effectively need to do that in advance of actually spending those 90 days. You can't suddenly decide on the 90th day that you're in Spain or Portugal or France or wherever that you want a visa. By then, it's going to take that much longer to get it. You're effectively overstaying. For those UK nationals that want to move to Europe, retire into Europe, then they need to also sort out a visa before they go. And then they need to convert that, in many cases, into a residency permit once they're there. That'll either be within the first 3 months of arrival, or it could be after 12 months if the visa is valid for 12 months. Now, in terms of the visa, the initial visa application has to be put into the consulate in the UK, not in the embassy or whatever in France or in Portugal. Wherever you do it at the French embassy in UK for France, you do it at the Portuguese embassy in the UK for Portugal. Now, they have offices, most of them have offices in London, Manchester, Edinburgh, those kind of places. You need to go through a process of application. So it's kind of changed the process of someone being allowed to spend more than 3 months in Europe at any one time or move into Europe. It's brought that activity to the fore rather than people being able to sort that out once they'd already moved and effectively doing it at their leisure. So that's the main area of change, really.
Yeah. And what about, do people end up being able to sort of get permanent residence in the countries and so on? How does that work?
Each country has a slightly different system, but the commonest is, let's take somewhere like France. You have a normal visa, which you will need to renew on an annual basis. Sorry, a residency permit that you'll have to renew on an annual basis. And to satisfy that residency permit, you have to prove that you have sufficient financial resources and that you have medical cover in place. That medical cover can come from either public or private means. So you might be part of the state system. You may have got into the subsidised healthcare system they have in France and across Europe, or you could be paying private medical insurance to cover that. And normally you're renewing that that residency permit on an annual basis. In Spain, you're renewing it generally on a bi-yearly basis, biannually, and similarly in Portugal. Then after 5 years, you can apply for a permanent residency permit, which generally then is only renewable every 5 years. But first, once you've gone through one lot of 5 years of permanent residency, so you've effectively got to 10 years overall, you can then look at going into things like citizenship and all that kind of stuff if you want to make your position that much more secure. Normally, people will just continue to renew their permanent residency card every 5 years.
Yeah. Now, I mean, one of the new requirements is the sort of financial resources to be able to demonstrate that you can support yourself, particularly if you're not going there on a work permit, obviously. And that has sort of changed things quite significantly for people on a lower income, and also varies quite significantly from country to country. Is that not right?
That's right. And a lot of countries in Europe, when we were part of the EU, just weren't particularly aggressive in making sure that people actually did get residency permits sorted out. It was actually a requirement that you were supposed to have one. But freedom of movement meant that it wasn't absolutely essential to have one in place. So the rules then weren't particularly observed, but the rules back then for actually financial resources was something in the region of whatever a country's unemployment benefit was, if someone was of working age, or whatever was the level of minimum state pension. So you're only looking at something in the region of around about kind of, 4,000 to 5,000 to 6,000 euros a year of income that you would have needed. That was if you ever sorted out a residency permit as an EU national in another state. So relatively low and not particularly observed. But what you see now is that, say, somewhere like France, you're looking at around 19,000 euros of what they call financial resources, which can either be income, it can be capital, it can be a cash pot. But they actually lower that number by what would be the social charges that might be taken off income. So you're looking at anything from 14,000 to 15,000 euros a year in France. Now, that can be for an individual, but the French consulate has said we will actually apply that number to a couple as well. In Portugal, the number is something in the region of 7,000 to 8,000 euros for an individual, or around 11,000 to 12,000 euros for a couple. So relatively low numbers there as well. But then you look at somewhere like Spain, which doesn't use the normal legal minimum wage as a kind of judge of what would be sufficient income. It uses a different number, another national statistic number, but that pushes the minimum income or minimum financial resources requirement up to about 34,000 euros. So Spain, which probably has maybe the lowest cost of living, certainly Portugal might be near that anyway, but a relatively low cost of living, has probably the highest requirement from a financial resources perspective. So people have to look at that and realise they've got to satisfy that number, but they haven't got to do that. If they're moving permanently, they want to live there for the long term, they've got to satisfy that number for the first 5 years. Once they go into permanent residency, they don't have to satisfy the financial requirements anymore. But for those first 5 years, they've got to show each time they renew their residency permit, be it annual or every 2 or 3 years, they are going to have to prove that they've got the sufficient resources to do it. And if the renewal is for more than a year, if it's for 2 years, say, then they've got to prove they've got double the income. They've got double the financial resources. If that country allows you to, say, use a capital pot in a bank account, if the income requirement was 35,000 euros, you're going to have to show you've got at least 70,000 euros there if the renewal is for a 2-year period. So you can see in a lot of cases now, particularly when it comes to somewhere like Spain, those people that may well have gone in and lived off of, say, a UK state pension plus perhaps another small amount on top, they may well be very much on the brink of not managing to certainly meet the specifications in Spain. And it's probably dubious whether they would manage that in somewhere like France. In Portugal, they may well meet it, but they look very much at income. They like to see a large proportion of the requirement matched by real income. So again, for people that may be retiring early, they may not want to crystallise a pension fund to turn it into an annuity. They won't have a state pension at that point in time. So you can see that in a lot of cases, this is going to be a more difficult thing to satisfy than perhaps it looks on paper. So it's something that people certainly need to take advice on. Now, one of the things that I found out when I was trying to research this particular subject matter is the lack of expertise in the UK on issues around moving to other countries. There is obviously expertise here on moving to somewhere like Australia, moving to Canada, moving to the USA, because the Brits have been doing that for a while and they've needed to satisfy visa and residency permit requirements to do that. We've only had to do that in respect of Europe for the last year. So there isn't the expertise in the UK. So we're having to go to immigration experts in country, so in France or Spain or wherever, and build those relationships to understand what the rules are. So again, it's another little bit of kind of psychological barrier there to people perhaps doing their own research, establishing what the rules are. So we've actually put on our website a number of immigration guides to each of the countries based around the different visas that somebody retiring would be able to apply for. Because obviously if you're retiring, you're not intending to work, you can't go for a work visa. You're restricted to people that, to visas that effectively do demand a certain level of financial resources. So passive income visa in Portugal, the non-lucrative visa in Spain. There are other visas. There's obviously, you've probably heard the terms or looked up golden visas, which require greater financial resources or financial investment in the country. But they can be quite sizable, but they give you a greater degree of freedom in your movement and flexibility in how long you spend in the country. The other thing that people need to realise is they really only should be going for the kind of 12-month visas and then looking to apply for residency permits if they are actually intending to spend more than 6 months a year in the country that they're applying for. That's because when they go to renew that residency permit, it probably wouldn't be renewed on the basis they haven't spent a sufficient amount of time to effectively activate the residency permit and convert it into a proper residency permit. You need to be spending at least 6 months a year in the country for that residency permit and its renewal to be valid.
Yeah. So I mean, I think one of the things that people often miss is that the golden visa does give you that flexibility. For instance, the Spanish golden visa allows you to spend between 1 and 365 days a year, which allows you to get past the 90 and 180 days. But the reality is that you're still capped at 183 days. if you don't want to become tax resident. So,
well, that's the other thing, and I think that's where a lot of the confusion comes from. And we certainly see it in email queries to us as a firm, is that people confuse the tax residency with immigration residency, or is it the proper, I think, legal residency is what they call it. Because there's both have a 6-month rule, so you do get a bit of confusion there. But yes, if you're spending more than 183 days in a country, then every country has a 6-month rule for tax purposes, including the UK. So if you're there for 183 days, you're a tax resident in that country for that tax year. Now, that could mean you're also tax resident in the UK as well, because the UK has its own residency rules, so you could be double tax resident. That's something we might talk about later on. But, that isn't horrific, but it's certainly something that you don't want to be getting into if you don't have to. But yeah, once you become tax resident, then you're exposing yourself to that country's taxes. And if you're a tax resident, from most countries' perspective, you're liable there on your worldwide income and gains. So again, be aware of that. It's not something you want to get into if you don't have to.
Okay, we've got a question in from somebody about the new digital nomad visa, which is under discussion in Spain. Is that something you know anything about, or if not, then we can cover that by email after the event?
I think it probably have to cover it in detail. It may well be something that's come out, because I know that a lot of people were looking at using non-lucrative visas, because they did allow you to work for, you couldn't work in Spain on the basis of a non-lucrative visa, but you could certainly work outside of Spain. So on the basis that someone is working via their computer, the internet, by phone, they could still work for perhaps a UK employer via those means, and still receive some form of income, earnings, but actually not from a Spanish employer. And on that basis, a lot of people were applying for the non-lucrative visa on that basis. I did see that there was a lot of people that were having those denied within the last 3 to 6 months or so, maybe longer, on that basis, when they were saying they were going to be working for a UK employer. So it could well be because there was a digital nomad visa coming out and was going to fill that space. I don't know of it in detail, so it's something we can probably answer by email afterwards, once I've done a bit of genning up.
Yeah, I think that one of the things that comes in the non-lucrative visa in Spain is that sort of working for an overseas employer should not be part of your application, but once you're here, then I think it is general practice, and quite a lot of people do that.
Yeah.
Well, you still have to be able to show that you've got the funds to support yourself without that income, and that's sort of part of it. So another question here, which is related really, is if you work for a UK-based company on salary but can work remotely, which countries allow this to contribute to your evidence of independent financial means? So that is not in Spain, but in Portugal you can work. Is that not correct? You can, under the passive income, so you can work. As I say, in Spain you can't use it to justify the amount, but you probably can do it once you've got the non-lucrative visa.
That's right. Yeah.
I'm not certain what the position is in France.
In France, I don't think there is a similar allowance. Their visa that they have there for people that aren't working doesn't. I don't think that allows you to work for a UK employer. You certainly can't work for a French employer.
Okay, and the other sort of issue we have with the new rules under our post-Brexit is healthcare, a number of the visas require you to have private healthcare initially, and the rules for the different countries are slightly different. Perhaps if I could just go into a bit of those sort of points around the healthcare. As I say, a number of them you have to have the private healthcare in place for when you first arrive, and then qualifying for the state system varies from country to country. Perhaps the first thing to cover is EHIC and GHIC. If you already have an EHIC, then you can continue to use that until it expires. When it expires, you replace it with the new GHIC, which has very similar terms. But the thing to bear in mind is that it can only be used when you're visiting. Once you become resident, the EHIC and the GHIC are not, do not give you access to it. And what they give you access to is necessary care, which doesn't cover you for everything. It doesn't cover you for, a medical evacuation or various other things, but it does cover you for things that you need to have during the period that you're visiting the country. If you become resident, you can, however, use that EHIC in other countries. So, for instance, if you're resident in Spain, you can use it when you visit France. Then, of course, once you become resident in the European country, you can then potentially get the equivalent to the EHIC from that country. And so, for instance, when you're going back to the UK as a resident of a European country, you're no longer entitled to access National Health Service. But if you have an EHIC equivalent from the country you're in, then you can use that to get, again, necessary care. So if you're employed in all the countries, then you'll be paying into the social security system, and that gives you access to healthcare. However, if you're not employed, then it varies from country to country. Sorry, if you're not employed, then it varies from country to country. In terms of early retirees in France, you can obtain access to healthcare on the basis that it is a residence-based system. And although it can take a bit of time to get it, therefore you will need private healthcare initially. It can take a period of up to 6 months to get fully set up on the French system. What they do is that you get the same terms as a French citizen, but the terms in France are not everything paid for. So on average, they cover about 70% of the costs. So initially you have to pay the cost and then get reimbursed. Ultimately, once you're fully set up in France, then that reimbursement will become automatic, but you still have to sort of pay the 30% or whatever it is based on each individual treatment. In Spain, you have to have private health insurance to get your national non-lucrative visa, and you can access but you can't access the Spanish system if you're not working. After 12 months in Spain, basically you have to be 12 months registered on the local authority site, which is basically being signed up on the Padron, as it's known. And once you've been on that for 12 months, then you can access it. But you access it by paying a monthly premium, not higher than 50, 60 euros a month, if I remember correctly. And there are some other conditions, but that you can do. In Portugal, it's a residency-based system, and you can access that system whether you're working or not. So that's a much easier system. In terms of pensioners, when you get a pensionable age, then you can apply for an S1, which you get from the UK government. That S1 basically says that the UK government will pay for your healthcare in Europe, and then you can use that to access healthcare in any of the countries if you don't qualify anyway, such as in Portugal, where you get it anyway as a resident. But the S1 enables you to get that, and you should get the S1 because obviously the Portuguese expect you to do that, so that the British government pays rather than the others. So hopefully that gives you an idea of the healthcare, and many people, of course, choose to have additional insurance. And for instance, in France, you can get top-up insurance that covers that 30%, and in any of the countries you can get private healthcare, which gives you the usual benefits of earlier access and so on, if you're wanting to do that. So hopefully that's given you an idea on the healthcare side.
I think the only thing I would add is just to say in terms of, say, someone like Portugal, they have a universal system. So as we've said, once you get your residency permit, then effectively you can enter the system and get the healthcare as free as a Portuguese citizen. So, you know, that's a pretty good system. All of the systems, all of these healthcare systems in Europe have a top up. So, you know, you're going to have 70 to 80 to 90% of the fees covered by, if you're in the system, covered by that subsidised healthcare system. But in most cases, it is best for you to buy the top up insurance. It's very cheap to do that because it is effectively a nationwide thing. Everybody does it. And, you know, what I would say is for you to actually get the visa in the first place, you have to show that you have medical insurance. So the quickest way to do that is to actually take out private medical insurance. But in most cases, you shouldn't be doing that for more than a year because it gets you the visa. Once you've then moved, you can get the residency permit. And then once you're there, you can look at the system, you can, you know, investigate it more and see what you need to do to get into it, to register, and to get it as free as you possibly can. So, you know, certainly in terms of France and Portugal, as you know, two of the main countries that Brits look to retire to, you can get in there at a relatively low cost. You know, in France, it might be you're paying a small amount of social charges on investment income or on a pension, but you can certainly minimise those social charges to make it relatively cheap. Spain, it's harder to get into the state system in terms of trying to get it on the same basis as a Spanish national. But as we've said, there is something called a convenio especial, which I'm not very good at saying things with a proper accent. But that, as we've said, is about 60 to 70 euros a month for a single person and about 150 euros for either a married couple or someone of state pension age. And then you then just need to weigh up whether that is as good as, in terms of services, or as, you know, how much does it cost in relative to a private scheme, a private pension plan, and what do you get for it, and what are the services compared to a private plan. In most cases, you're probably going to find that actually the state system is probably cheaper, but it's just to be aware of that. Normally as well, private medical insurance actually in Europe is cheaper than it would be in the UK, very slightly cheaper than it is in the UK, just as generality.
Right. Okay. Thank you. Well, moving on from healthcare, the commonest scenario that I see is somebody looking to buy a holiday home.
Yeah.
And where the intention is to visit for sort of 5 or 10 years, and then at some point they intend to retire and increase their time there. What are the tax consequences of this sort of approach?
I think, you know, we see it an awful lot. We take stands at the various different overseas property shows in the UK, and it's probably the commonest course of action that someone describes to us when they come up and talk to us is, you know, I've received an inheritance, I've been saving a long time, I'm going to go and buy a holiday home in, you know, one of our European hotspots where UK nationals like to go. I'm going to visit there for a good few years, but my intention is when I get to 60, I'm going to retire there and live there. And then I'm going to sell my UK home. And quite often you see that they want to retain the UK home afterwards, either as a rental property, to have a form of income, sometimes as just somewhere to come back to in the UK when they visit friends, other times almost as a fallback option. You know, should they 2 or 3 years down the line think, I've given this a go, it's not worked, I'm coming back, you know. So you do see that kind of scenario. Most people don't think that the UK home is going to be something that would ever be taxable when they sell it. And the main reason is because, you know, most UK people will buy their home, live in it, and when they sell it, they don't have to pay any capital gains tax because they've lived in it all the time they've occupied it. And on that basis, it wouldn't be taxable, it would be exempt from capital gains tax because it's been the main home throughout the period of ownership. The issue you have in the UK is that we have something called qualifying and non-qualifying periods of occupation of the property. So if you owned a property for 10 years, but you only lived in it for 5 and you sell it at the end of those 10 years, then potentially 50% of the gain would be taxable to capital gains tax because you haven't occupied it as the main home for 5 out of the 10 years. Now, there are different exemptions for periods of non-occupation, be it that you leave it and go and work somewhere in the UK, somewhere else in the UK, or somewhere around the world, and you come back. And you're also allowed a period at the end before you sell it where it can be unoccupied but still be exempt. Now that period used to be, I think it was prior to 2014, that period was 36 months. So you could leave the property unoccupied for 3 months. That's 36 months before you'd sold it, and the whole period of ownership would still be exempt. That came down to 12 months, I think, back in 2019, but that period has now come down to 9 months very recently. So the period that you can be unoccupied for at the end is now very short. And if you're someone who's moving abroad, potentially if you're going to retain that UK property but sell it a number of years down the line, then an element of that gain could be liable to capital gains tax in the UK. And if you're living in the right area where the property has gone up a lot in value, and we've seen some ludicrous increases in value over the last 12 to 18 months, you could be seeing, a half decent gain on that property, which even if there's only a couple of years of it taxable, will still give you something to think about. But it's not only from the UK you have to look at it, you have to look at it from the country you're moving to. Because if you're retaining your UK property until after you've moved, and if you're moving your family and you're moving your life to another country, then effectively you're proving that you're becoming tax resident there effectively from the outset, not after 6 months. In most cases, you're going to be tax resident from the outset because you're showing that change in your life. And on that basis, you've then got to look at the rules around main homes from Spain's perspective or Portugal's perspective or wherever, and understand what those rules are. Because the UK property, you've become tax resident in Spain, but you're taxable there on a worldwide basis. Whatever activity you have around the world, be it income and gains, then is potentially liable in Spain or Portugal or France. So on that basis, the sale of a UK property would potentially be liable in that country. So you have to look at the rules that operate there. Now, they don't have the same rules as the UK. The UK is probably the only country that has this occupation, non-occupation periods, which can be exempt or liable. And it is quite a favourable system. Abroad, it is all about, certainly in those three main countries, it is all about what is the position of the property at the point you sell it. And if the position of that property at the point you sell it is it's not your main home at that point in time, then it is potentially liable to capital gains tax in Spain or in Portugal or in France. There are exemptions for periods up to 24 months before. So if you've left the property and you sell it inside of 24 months of having left, then you're probably going to be exempt on the gain. But once you go beyond that, the property could be liable, but liable on a basis where the whole gain could be chargeable to tax. There's no occupation, non-occupation periods abroad, as we said. So it's being aware of those rules before you go ahead and put your plans in place. You can still do them, but it's just knowing what your exposure is if you decide to sell a property, a UK property, 4 or 5 years down the line once you move. It's being aware of that and what the situation might be, so you can plan for that, and also so you can make the correct returns to the tax authorities in Spain or in Portugal or in France. Because if you don't do that, then the penalty and interest regimes in those countries are sizable. And it's worthwhile making sure you understand that, know when you've got to get the details in, what return you've got to put it on, what details you've got to provide.
Okay. So the majority of retirees will be living off pensions and investments when they move abroad. What are the sort of broad brush things they should be aware of in terms of?
I think probably the simplest one is that in Europe you don't have this 25% lump sum that you can take from your pension scheme that you can in the UK. You hear about it being the proper term for it is a pension commencement lump sum, PCLS, but people know it as the 25% tax-free lump sum. That's how they see it described. And as that says, it is, if you take that lump sum, 25% in the UK when you're UK tax resident, then that will be tax-free. So, if someone has a defined contribution scheme, a DC scheme, a SIP or whatever, and they have 500,000 in that, then pension commencement lump sum maximum would be 125,000, and that would be tax-free if you take that in the UK. That's not the same in Europe. And the way that pensions are treated when you're living in Europe, but your pension scheme might be in the UK, is you then have to look at the double tax treaty between the UK and Portugal, UK and Spain, UK and France, say, if you're living in one of those countries. The UK has an incredibly wide network of treaties, we've probably got more treaties than any other country in the world. Certainly we've got a treaty with every country that's in the European Union. So there will be a rule in there as to where the pension will be taxable. But basically the rules are that if you have a private pension like a SIP, if you have a company pension, be it one that you pay into or one that the company is going to make a provision, or if you have a UK state pension, that is taxable wherever you are tax resident, not where the scheme is originating from. Okay, so if you've moved to Spain, and that's going to be taxable in Spain, not the UK. Okay, whatever you take from that. If you have a government pension, which is if you've been a government employee, be it national government, local government, a teacher, someone along those lines may have worked at a local authority, whatever, that always remains taxable in the UK. Even if you've moved abroad, it stays taxable in the UK, not in the country you've moved to. That's the one difference. Now, if you've moved to Spain or France before you've taken that 25% lump sum, then it's taxable according to Spain's rules or France's rules or Portugal's rules, not the UK. And those countries do not allow you to take any element of tax-free pension. Okay, so what you've got is a situation, if you leave it until you've moved, it won't be taxable in the UK, but potentially it's going to be liable in the country you've moved to. So the starting point for me, the simplest thing you can do is always take the 25% lump sum before you've left the UK. And then, depending upon what you want to do with the rest of your pension fund, that is then liable to whatever the country you've moved to, whatever the rules are there. Now, there are certain countries that do tax pensions in different ways. So, somewhere like France, if you're going to receive an annual income from the pension, be it taking the money out of the scheme itself or converting the fund into an annuity, so you're receiving it almost on a monthly basis, that would be taxable normally to income tax with rates up to 45%, just like the UK, that sort of thing. But actually, if you, with the pension freedoms that we have in the UK, which allow us to be quite flexible in how we take the money out of our pension schemes, if you're taking further lump sums from your pension scheme, which you can do that whenever you want. You can do it over and above the 25%, take it regularly or intermittently. In France, if you take one single lump sum, so almost if you take the whole amount, the other 75% out in one go, they would tax that at 7.5%. Now, if you are under state pension age, then there's a very similar amount that you would pay in social charges on top. But if you're over state pension age, then you pay no social charges on that lump sum. So if you are someone that was looking at taking out holding a pension fund, or at least getting it out tax efficiently and then doing something with it which you can live off very similarly to a pension, but again in a tax efficient way, then you can do that in France for 7.5% income tax. If you've gone to Portugal, then they have something called the non-habitual residence scheme, which my colleague will go into in greater detail in a similar webinar to this on Thursday. But you can apply for something called non-habitual residence regime for the first 10 years, where you'll only pay 10% on any pension income for those first 10 years in Portugal. So there are different things you can do in different countries, different reliefs that are available to you, which allow you to live off your income much more tax efficiently than it would be in the UK. Now, if you've got capital, whatever, or if you've took those monies out of your pension fund, you need to do something with them because they're going to be used for you to live off going forwards. You can then invest into quite a similar product to what we have in the UK. We have what we call an offshore life assurance policy or certificate or wrapper. It is like a tax wrapper, and you hold in there like an investment portfolio, a bit like would underlie a pension scheme anyway. You have a normal investment portfolio holding funds or something like that. You can then effectively the tax wrapper around that, the life assurance policy, stops any tax being payable on that portfolio on an ongoing basis. You'll only pay tax when you draw monies off it to live off. And then you'll only pay, it's quite difficult to describe this, you'll only pay tax on the element of what we call income within the amount that you withdraw. And the simplest way I can explain that is to say if you put £100 in and a year later it's worth 110, and you take £11 out that year later, only £1 of that 11 is taxable because it's in proportion to the income of the whole policy. So the whole policy has £10 of income in it, and that £1 represents that same proportion of the income to the whole. So you're not being taxed on the whole 10, even though you're taking out 11, you're only being taxed on the proportion of income in that 11, which is 1. So it is quite a good way to live tax efficiently going forwards when you're not taxed on the whole sum you're withdrawing. So if that had been a pension and you've got 11, that would be £11 taxable. If you take it from this vehicle, you're only on £1 taxable. So they're the kind of structures that we use for our people living abroad, and they're well established in Europe, completely and utterly conservative and compliant, and certainly vehicles that we've been using all the time. And actually, in countries like France, where it's called an assurance V, a huge percentage of the population use those vehicles as a means for saving or holding investments.
Right. And the other things perhaps worth mentioning in this area is the wealth tax that applies in certain countries. Could you perhaps tell us a bit more about wealth?
Yeah, people have probably, in the papers in the UK, we've seen lots of reports of wealth tax as potentially a means of trying to fill that the gap between what's really required to satisfy the social care costs that we have in the UK. Wealth tax was one of those ideas that came up. It's certainly not something. It's something that's not new in Europe, and the countries that we're mainly talking about here, France, Spain, and Portugal, all have their own forms of wealth tax. In most cases, they're only kicking in once your assets are worth a certain amount of money. But once you've moved to that country, certainly in terms of Spain and Portugal, you're looking at your worldwide assets, whilst in France, you're only looking at French assets for the first 5 years. And once those first 5 years have passed, you are looking at worldwide assets. Now, Spain, you're looking at everything that you have, apart from what I would call business assets, be they, assets that you own for in a business, shop premises or something like that, or if you have a company, the shares in that company, they would fall outside of wealth tax, but you are pretty much looking at everything else like, property, investments. There is something going on at the moment that may well put pensions into that bracket as well, but we're not quite sure. There's been a ruling that we're not quite sure if pensions are included from a Spanish perspective. In France, it did used to be everything, but Macron has reduced that down to just being real estate or the valuation of real estate companies. Whilst in Portugal, it is just on real estate. In Portugal, you're looking at, with a couple, an exemption of about 1.2 million. But remember, you are looking worldwide. So, a lot of people in the UK have property portfolios built up of buy-to-lets that they want to keep and use as a means of income to live off in their retirement. Well, if you're moving to the 3 countries we're talking about, they would be assets for wealth tax purposes. So it's that kind of thing you have to think about going forwards. What do I need to change from my asset mix? What do I need to look at? Is there ways I can hold these assets differently via different structures, which may eliminate them from the wealth tax boundaries? As I said, so in Portugal, if it's a couple, it's 1.2 million. Anything over that is potentially liable from if it's property. If it's France, it's 1.3 million euros. But then once you've gone over that from a property or a property company perspective, then actually you'll start paying tax on the value on anything in excess of 800,000 value. In Spain, you're looking at an exemption, including all of the different reliefs, of about 2 million for a couple. But as I said, then potentially it's on worldwide assets. And in Spain, it's all on the different regions. So there's slightly different levels in each different region, 17 autonomous regions in Spain. But it's a maximum of 3.5% on anything over 10 million of value. So now for the very wealthy, it can be quite a heavy tax. And in most cases, you're paying it annually. And you're not selling down assets to pay the wealth tax. So in most cases, it's coming out of income. So one of the best ways to actually reduce a wealth tax exposure is to reduce your taxable income. And it's the word taxable that's there. You know, if you can receive income or at least funds, monies to live off in a different form than income, then obviously you're not creating income, because wealth tax can only pay wealth tax up to a certain level of income. You don't want to see someone's income completely paid away in wealth tax, because what would they live off? So effectively what in most countries what you're saying is, if your wealth tax would be too high a percentage of your income, you would only pay a certain level of wealth tax. So I think in Spain it's something like it can only be 60% of your income. But if your income is incredibly low, then your wealth tax will be relatively low, regardless of how much your assets are worth. So it's those kind of things that you need to think about in terms of when you are looking at moving. If you do have quite a lot of value, particularly in property, it's those kind of things you need to think about when you're thinking, I actually don't want to just holiday in these countries. I want to move there. You've got to be aware of that if you think your wealth, that your value of property is above a certain level.
Right. Okay. I've got a question here sent in. I'm looking at property in Mallorca and the Algarve, which once I require, I will move into in the next few years. Do I need to think about inheritance or estate taxes?
Well, if you're able to afford property in the Algarve and Mallorca, because they're probably the higher price brackets of properties that our clients certainly look at, then you probably have enough money to buy that property and probably have enough other, you probably have quite a lot of other wealth around the place as well. So once you move to those countries, then you fall into their, once you actually buy property in those countries, those properties become potentially liable to that country's estate taxes. If you move there, then again, you're going to become potentially liable to your worldwide assets become potentially liable to that country's estate taxes. But also bear in mind that as a UK domiciled person, and nowadays, so that's someone who originates from the UK, whose family came from the UK, then you're very highly likely to retain your UK domicile, regardless of how long you spend abroad. On that, inheritance tax in the UK is determined by what your domicile is. And with a UK domicile, you're liable to UK inheritance tax, again, on a worldwide basis. So you've got the potential situation of double exposure to estate taxes or inheritance taxes from both the UK point of view and the country you've moved to. Now, in most cases, they're going to be conflicting legal systems, because the UK is a common law country and most countries in Europe are civil law countries. So there are different rules then about how you can pass assets, who you can pass them to, and what levels of tax might be payable. And what you have across the majority of Europe is what we would call forced heirship, where in the strict kind of explanation of the rules and interpretation of the rules is that you have to leave a fixed percentage to children, and what percentage you leave to them is determined by the number of children that you have, and it varies from one country to the other, but it all came out of what we call the Napoleonic Codes, so it's been around for a long time. So, on a very strict basis, they're quite conflicting systems, because the UK, you have complete testamentary freedom, who you can give an asset to, who you can will it to, So there's conflicting systems there. Now, Europe has tried to kind of clarify that and make it a little bit more simple in terms of the process by introducing new European succession regulations back in 2015. Now, whilst the UK didn't sign up to them, if you own property in the EU or if you live in the EU, then you are able to benefit from those EU succession regulations in respect of the property you have located there, or if you've moved there in respect of what your exposure might be to that country's estate taxes or inheritance tax. And it allows you to basically look at the succession law that might apply without any changes or you adding anything into your will or anything into a legal document. You would pass your assets according to the national law of the country you're living in. So that would require you to make provision for children, etc., on the basis of the forced heirship regime as it is. But if you make an election in your will or another legal document to say you want the European succession regulations to apply, which mean that you can suspend the rule of the country you're in and apply the rules of your nationality, which is the UK or at least England, then you then can say, I want to apply the succession rules of the UK in my will. And once you've said that, you can then make the will and pass the assets according to UK rules. And those UK rules give you testamentary freedom to pass it to whoever you want. Now that's great because it gives you the same flexibility as the UK, and your wills can almost mirror each other from a UK and a European perspective. But what you've got to remember is the actual succession tax that might arise in the European country you're living in, Spain, Portugal, and France maybe, the communist countries. The succession tax you're going to pay there is according to their rules. So if you decide you want to pass your asset to someone, a friend, then they have no relationship with you apart from being a friend. That means that they are completely detached from you. There is no relationship with you, and therefore the highest rate of inheritance tax is going to apply to that kind of testamentary disposition. So, you know, you're going to have very, very minimal, if any, exemption on that kind of passing to a beneficiary, but also you're going to hit the highest rates of inheritance or succession tax very quickly, which in some countries could be 60, 65%, with other add-ons as well, which could push it up to 85, 90%. You're going to hit that very quickly because it's someone that's not related to you and certainly not related to you closely enough to get all of the allowances and reliefs that you get in those countries for passing assets on. Now, you know, that you could be hitting those rates certainly in France and Spain quite easily. In Portugal, people say you don't have inheritance tax. You do have something called a stamp duty at 10%, but that doesn't apply when you're passing assets to a spouse, children, or parents. So, you know, the kind of normal gifts or bequeathments you would make, you're not going to pay any inheritance tax in Portugal on. And the other ones, if you're passing them to someone relatively close, there are very high exemptions available there, and you don't hit the highest rates of tax. That's the other thing to be aware of, is that in the UK, it's the estate that is taxed, and then the assets are distributed out to the beneficiaries. Abroad, it is the beneficiaries that pay the tax, and the rate of tax is dependent upon how close their relationship is with the person who's passed away. So again, it's a different system. Now, certainly there are estate tax treaties, certainly one with France, which makes things a little bit simpler, because there is a set rules about where the liability would arise and what bits are exempt, and if you pay tax here, you won't have to pay it there. But in terms of the other countries, there's a great deal of precedence that's been established through different case law, etc., which certainly lays out a form of system that can be applied to say where the liability is going to rise. And you can set this tax off against the liability in the other country. So, you know, there is a degree of there's a degree of system there, a degree of process which helps you, but it can be expensive from a legal point of view. So it's certainly worthwhile having a UK will in most cases, for your UK and worldwide assets, and in the country you move to, you'll need a will there from the perspective of the assets that you have in that country, depending upon what the case law is, depending upon whether that should apply for other assets around the world or whether the UK will should cover those. That will depend upon what the case law is in that respect for that country. But it makes things a little bit more. It's worth having the wills in place because then at least you know where the assets are going to go. Probate and getting agreement under each different country and having two different lawyers sorting that out for you will make it a little bit more expensive. So it's worthwhile making things as simple as possible.
Okay. Well, thank you. Clearly a complicated area.
Yeah.
Got a few questions in. So first one here, I have a defined benefit pension scheme with a sizable transfer value. I've been in the process of transferring this to a QROPS, but my IFA is now saying there is a problem with some recent pension law changes which may stop the whole thing. Can you tell what's going on?
I think this is probably relating to some recent changes that came in the UK. There was a perceived problem that if somebody said they wanted to transfer their pension to another form of scheme, then even if an advisor, the trustee of that pension scheme, if they were requested to make that transfer, then the trustee had to make the transfer that was being requested by the scheme holder. Now, what that did is that opened up a lot of people who had pension funds, particularly defined benefit schemes, which can have, because of the GAD rates and the gilt rates that apply, can have quite sizable transfer values if someone's worked at one company for a good number of years and have earned a half decent salary while they've been there. Then the transfer values can be huge on some of those pensions, and that's opened those people up to some, obviously, how can I describe it? Advice that's perhaps not above board, and for those monies to be transferred into schemes where those pension funds can either be whittled away with investments that pay particularly large commissions, or those monies can just disappear. So to try and avoid those kind of situations, and the requirement for trustees to make those transfers so they don't have a choice, is they're effectively trying to give the trustees more responsibility and a greater ability to say no. And what they've brought in is what they call a flagging system to where the money is going. So if you're in this kind of scenario that the questioner has asked, is one, it's a defined benefit scheme, which is a kind of scheme that needs the highest level of advice in the UK. It needs at least a level 6 qualified pension advisor that's done all the right exams to give the advice. And there should only be a relatively narrow number of situations where the transfer of a defined benefit scheme should be recommended, even on the insistence of the taxpayer, of the scheme holder. But if it's that kind of thing, then that kind of raises, that should be raising the trustees' flag straight away. But if they're looking at transferring it certainly to an offshore plan, like a QROPS, qualifying recognised overseas pension scheme, then there's a flagging system there. And if you're looking at what's might be an amber flag, and that's where basically the trustee thinks that the individual should, over and above the advice he's getting from the IFA, should then get further advice. That further advice would come from the, I can't remember what the name of the body is, but effectively you're going to have a conversation with a money advice person that's effectively set up by government to make sure that you've taken all the right advice, you've considered everything correctly, and only then will the transfer be allowed to take place after that has been documented, that call or that online meeting has taken place. But then in other situations, it will show up a red flag. Now, a red flag is where it probably is going to an offshore scheme, and there is the potential for those monies, certainly a higher percentage chance of those monies being either whittled away or potentially stolen. or the type of investments they might be going into, if those investments pay a high commission, if those investments are esoteric, if they're not on a regular exchange, they're not on the FTSE, whatever, that kind of thing, then the trustee is able to put that down as a red flag and effectively say, I'm red flagging this, I'm denying the transfer.
Right.
So, and that's literally only came out in October 2021, and all the trustees literally had something in the region of 2 or 3 weeks to put in place new processes to deal with this. So a lot of them effectively just stopped transfers straight away, like almost any sort of transfer, and said, right, we need to put new processes, new rules in place. And then as they opened up, kind of, the pension regulator did lay down the kind of things that they needed to look for. In terms of, this would be dodgy, this wouldn't be right, you shouldn't do this. Those kind of things which would put it into amber and red flag territory. And certainly a transfer abroad is, probably on the brink of red flag straight away, without anything else occurring at all. So it may well be that individual person there may well have to look at transferring it if he still wants to make that transfer, and it's what he wishes, and the financial advisor is still willing to recommend that. That transfer may now only occur to let's say a UK SIP or something like that, and then potentially there may be a future transfer that could occur to a QROPS in the future. But that depends. There's still a lot you can do with a SIP if depending upon what the guy's planning to do, if he's or lady, if they're looking to move abroad, then there's still a lot you can do with a SIP anyway from the European perspective.
Okay. Another question here. I moved to Spain a few years ago, but I reached retirement age this year. How do I get the UK state pension? And perhaps I'll answer that one because I'm currently going through this myself. I live in Spain, and there's basically 2 options. You can either download the international claim form from the DWP site, or you can make a claim by phone. The international claim form is not very easy because it asks questions like, have you ever lived in the UK? It asks for every address you've ever had in the UK, every employer you've ever had in the UK. So, as somebody who may have spent most of their life or all of their lives in the UK and then deciding to retire, it's a sort of slightly odd sort of series of questions. So the easiest thing may well be to phone, where you can make a claim by phone. I am about to do that myself. And one of the things to note is that those lines are only open between 9:30 and 3:30 currently due to COVID. Normally they're open until about 6, I think. But at the moment, they're only open between 9:30 and 3:30. Once you've got that pension, you can have your pension paid either to a UK account or into a bank in the country where you live. So hopefully that covers that one. Another question, Jason. My lawyer in Spain is recommending a golden visa because of the flexibility it gives me coming and going as I please, which does appeal to the person. But I don't want to move to Spain and become a tax resident for at least 3 years. So
I think, a lot of people that, are wealthy and therefore don't see the financial cost of, the legal costs and what you might need to invest into Spain to get a golden visa. Certainly like the flexibility that it gives them because it allows them to come and go as they please. You don't even have to, literally spend 1 day in Spain and that's sufficient. You don't even have to visit, but literally it allows you then to spend as many days as you want in Spain, come and go as you please, and then to obtain a permanent residency permit in the future. So it gives that level of flexibility that you don't have to be there for at least 6 months a year. What I would say is you still are liable to the tax rules, and those tax rules are, as we've already said, if you spend more than 183 days, so 6 months in Spain, then you will become tax resident. So if you're not looking at spending that long, but you want the security of having the ability to come and go as you please, then certainly the golden visa is something that you can look at. But what you have to be aware of the investment you'll be required to make, normally in the form of real estate. That's the commonest way that people satisfy the requirements of the Golden Visa application. And if you were going to buy a property in Spain anyway, you're kind of killing two birds with one stone. You're going to buy it to holiday in and to visit, then potentially, if you're going to spend a certain amount of money, then I can't remember the exact amount. It might be close to 500,000. I'm not sure. I think Portugal and Spain mixed up. It certainly was 500,000.
In Spain, it is 500,000. Yes.
Yeah.
In Portugal, there are various options at different levels.
Now, if you're going to spend, if you're looking at the places we talked about before, Marbella, if you're looking at Mallorca, certainly certain areas of Ibiza, if you're looking at some of those areas, then you're probably going to have to spend 500,000 for a nice villa and maybe a pool as well. Anyway, so if you were going to do that, then obviously the Golden Visa is a route to you. What you need to be aware of is the cost. So the legal costs are going to be more, but obviously, if you have sufficient wealth anyway, then that may not be an issue for you. But actually, it can be a lot quicker to get than going through the process of a normal non-lucrative visa, which if you were going to spend more than 6 months there anyway, it's something that, you might as well go down the non-lucrative visa route. If you were definitely going to be there for more than 6 months a year, that you might as well go that route because it's cheaper. But in terms of the Golden Visa, you can actually get it very quickly, normally in about 3 months. If you're buying property, you just have to travel into Spain a couple of times to have a couple of meetings with the immigration authorities, and you should be getting that visa pretty fast once you've got the property. Just go there a few times and it'll all be sorted out. But it all depends upon circumstances, what your intentions are, what your movements are going to be, and then decide, well, is this important for me to have the flexibility? But be aware, over 6 months, you're going to be tax resident in Spain. The UK, and this is something that we should have probably mentioned earlier on when we were talking about tax residence, is the UK has its own statutory residence tests. And they're quite complicated and long-winded. It's all about connections to the UK, which determines the number of days you can spend in the UK before becoming tax resident. But what you need to be aware of is that in general, if you stay under 3 months on a rolling basis each year in the UK, then you're not tax resident here. But if you're someone who has been living in the UK long term and then you decide to move abroad, then you need to make sure that you stay under roughly 3 months a year, 90 days a year, to be not tax resident in the UK. If you're over that, then you're probably going to retain your UK tax residency. If you've moved to another country and spending more than 6 months a year there, you'll be tax resident there as well. So you'll be double tax resident. And on that basis, the double tax treaty determines where tax is payable on what income and what gains. It's not the end of the world. It doesn't mean you're paying double tax, because that's what the double tax treaty is there for. It allows you to set tax off that you pay in one country against the liability in the other, so you don't pay double, or it says the tax will only be payable in one of those countries. But it increases the aggravation level because you're going to have two lots of administration going on, two different tax accountants doing your returns, and there will be a degree of overlap in systems, and you may have to pay tax in one country before you can get relief for it, or you might have to pay it in both to get relief and get the money back subsequently. It's just an awkward situation. It demands a bit more administration and probably a bit more professional costs if you find yourself in that scenario. But most people, try and stay out of that kind of situation. But just something which should have probably mentioned earlier.
Okay. Another one here, comment, I guess. I thought France had high taxes as well as social charges. Are you saying that retirees, it can be quite tax efficient?
This probably come out of what we said about pensions earlier on and the 7.5% on lump sums and that sort of thing, and the fact that you can use an assurance fee, life assurance product to live a low tax life effectively. It's quite interesting. But most of the interpretation, or certainly the way people look at France, is it's very high taxing. It has a top rate of tax of 45%, which kicks in at about 130,000 euros. So not, it's different from the UK. It kicks in lower than the UK. but the top rate is the same. It has lots more individual rates in between to get to that point. But what it also has on top, which a lot of people focus on, is social charges. Now, social charges look like UK national insurance. Okay, they're not the same thing, but they look like national insurance. But in other countries in Europe, their version of social charges is like the UK, in that it's only payable generally on employment income or self-employment income. In France, they pay it on pretty much every form of income: investment income, pension income, whatever. You'll pay some form of social charge. Now, that can kick up the top rate of social charges, can make sure that 45% becomes certainly in excess of 60 at a social charges highest rate. That's why a lot of people look at that top headline number and go, oh, you know, France can be quite taxing. But as a retiree, somebody who's not going to have earned income or self-employed income, then actually social charges can be relatively low and actually can be zero, depending upon what forms of income you have. So if you're living off of investment income using something like an Assurance V vehicle, not only are you reducing the taxable income element of what you're living off by that basis that I described earlier on, but also you've got the ability, it pays a much lower rate of social charge. You've also got the ability then to take down the pension and eliminate the pension as a form of something for social charges. You can take the lump sum, only pay 7.5%, and then move that money potentially into an Assurance V to live off going forwards. And again, you have that much lower rate of taxation and the social charges that apply there. So yes, France for retirees can be quite attractive as long as you structure things correctly, as long as you've took the tax, the French tax advice, you've structured things correctly going forwards, and you're making sure that you do everything correctly in line with the rules, but with what's available to you to make things as tax efficient as they can be.
Okay, one more question here. I'm about to move to the Silver Coast in Portugal, but had not even thought about estate taxes, as my lawyer said there aren't any. So is that right?
well, yeah, literally, they don't have something called estate tax, succession tax, but as I said, they do have this stamp duty, which is at 10%. So it's not anywhere near as high as normal estate tax rates would be. And also, if you're passing the assets to who you would normally pass them to, which is going to be a spouse and children, then that stamp duty isn't payable on those assets passed to those beneficiaries. So, it's only if you're going outside of that potentially stamp duty due. But if you do things right and if you pass assets in the correct way, you're going to have a minimal amount of stamp duty payable in Portugal. Now, that doesn't mean that you're not going to have a UK inheritance tax exposure, because remember what I said was you're probably going to retain your UK domicile, which means you're going to be exposed to UK inheritance tax on a worldwide basis. So you must be aware of that and be aware of who you're looking to pass your assets to and what the potential liabilities are there. You've got the exemptions in the UK, the tax-free allowances. So again, make sure that everything's done right where you're factoring in both the UK and the Portuguese position in the dispositions you're looking to make via your will, etc.
Right. Okay, that I think covers all the questions we have there, Jason. So thanks very much for that talk, very useful. What I would just like to say before we go is that we have, as Jason did mention, non-habitual resident scheme webinar on Thursday for the Portuguese non-habitual resident scheme. Also, we're aimed to be here to support you in any moves you make or if any questions you have. So if you have any questions, please feel free to send them in or contact Jason direct, obviously. But you can send it in to us at expats@expatnetwork.com, and we will either answer it ourselves if we're able to, or we will pass it on to somebody within our network who is able to answer it. And obviously in this area, that's likely to be Jason. Okay, so thank you everybody much, and we'll call it to an end at that point. Many thanks.
Thank you.
Thanks, Jason.